Good evening and welcome to the April Investor Advisory Review, your financial journey, creating, growing, protecting, and preserving your family's wealth in today's economy. And I am so glad to be with you again tonight. It's been just a month ago that we had a conversation about the investments and the economy and what's happening in the world, and a lot has continued to transpire between now and then. So hopefully tonight we'll give you some more information that helps make your decisions easier and better as you go forward. There we go. As always, the important disclosures. I think sometimes people think that this is just silly to put these on here, but we have to. One, because it's required, but more importantly, I want to remind everybody that what we do as wealth advisors is complex. There are tax issues, there's investment issues, there's legal issues, there are liquidity, income, growth, risk issues that have to be considered. And so no matter what decisions you make sure that you've made decisions that are appropriate for a situation today as well as into the future. And that's what these disclosures are designed to remind you of. It's a complex decision in many cases, and make them wisely. We'll take time for questions as always at the end. I will go through and outline a lot of points today that hopefully will give you some new insight into some of the things that I'm seeing, that our investment partners are seeing, to kind of help you make good decisions as we go through this process. But again, we'll take time for questions at the end. You can either type your question in in the chat box or raise your hand, and I'll be happy to deal with that as we get towards the end of the session here. We're going to take a few moments for the economic and market review. I want to talk about investment strategies during challenging economic times. As always, we'll talk about some of the strategies that we're using to create, grow, protect, and preserve wealth in this economy, and I'll show you more specifically some things we're doing at this time. We'll also look at the resources available to you that we provide to hopefully give you the information to make informed decisions. I'll share some final thoughts and then questions, and then we'll remind you of the next Investor Advisory Review coming up. See, we've already got a hand up here to make sure that I haven't forgot something. Okay, not questions at this point, but again, I will be happy to go through that here as we go further on. As I talked about last time, and I brought this slide up, which has been updated by the conference board, and it actually is more conservative than a lot of the resources that we are currently looking at. One of the things, though, that I thought was important was that when we showed you this, when I showed you this in last month's review, they had real GDP for Q1 estimated to be 1% growth. They've now updated to 2%, and we've seen as high as 2.6 when we see the economic numbers for what we're seeing in January, February, and March. With that in mind, we are just one second. Oh, let me just double check something here. Diane, I'm checking. I can see the mic is working, so maybe it's the sound on your side if you want to just check the sound. But if anybody else is not getting sound, please raise your hand or whatever, because it looks to me like we have sound going out. Hopefully that will answer that for you. Anyway, as I mentioned at the end of our webinar last time, that we watch these as sort of guardrails. If we're doing better than what these numbers tell us, that's one set of metrics that we use to make decisions on how things are going forward. If we see the numbers being less or worse than what they are telling us they anticipated, we see that as a different set of responses. Now, I just want to point out that even though this was updated as of April 12th, I don't know that means that anything has changed as far as expected recession, and maybe being a shallow but a 2 to 3-quarter recession. That seems to be the sort of standard thinking for everybody. It's just that this first quarter turned out to be better than we thought, which is important because it might mean that some of the results might be that the recession is more shallow than we're expecting. Again, every piece is just one more word in a sentence, if you will. And so we try to figure out from these various words in the sentences and the paragraphs what we think this means as we move on down the markets move on down the road investing for the markets and the economy. Another piece here that I wanted to spend some time on, and this has to do with just how we show you the next slide where we show the airplane and the 4 economic engines that we look at. But you can see here that for the last couple of months, even though we've had some nice GDP growth, you'll notice here that the corporate profits have gone into a more negative area. It doesn't mean that they're not making money. It just means they're not making money as well as they had previously. And when I looked at the data, it looked like they were making money, but oh, wonderful, very good. It means that they're making money, just not as much as they did before. Now, when I compare where we are today to say where the same numbers were for the pandemic, it's not as bad as it was. As a matter of fact, the pandemic was actually worse on corporate profits than what we're seeing today. But we have gone into negative earnings here. Now, what you're looking at, the blue line is the S&P 500. The black line is if we exclude energy from the mix, which simply means by taking energy out, the numbers are worse. So energy is kind of helping to hold it up a bit. Having said that, it is moved into negative territory, and we anticipate that to continue to be the case for a while. So if I were to put this on the on our airplane model for the U.S. economy, what I'd say is that GDP growth for the first quarter, we give it a plus. It's estimated. I think it's going to be a plus no matter what, but it is a plus. We just don't know the exact number yet, but that should be coming out. Business profitability, we give it a negative. That engine might be stalling out a bit. Not that they're losing money, but they're just not making money as much as we'd like to see them in that above 10% column. And unemployment rates are still very low. Even though they raised up just a tick, they're still low, so that's a plus. And interest rates being a little higher. I was just talking with a client today who's borrowing to buy a car, and her rates were a little higher than what they had been the last time she did that. But at the same time, those rates being a little higher is also good because people who have money in savings or money market accounts, or they have them in some liquid investment accounts, they're getting more on their money. They're getting more on CD rates right now, which is helpful. So it's kind of a plus and minus. Now, if interest rates were to go significantly higher, it would become a minus, even though it's true that they'd be making more money. It's just that from a market viewpoint, it would be seen as even more of a negative because corporations would have to spend more to borrow money to grow, and that would really be a problem. So we see it as a plus minus right now. So 2 of the engines we think are running pretty well. One may have flamed out a little bit, or at least slowed down a bit, and the last one is kind of still puttering along. We'd like to see it a little bit better. So these are good signs. It's not a bad, terrible economy, but it's not as good as we'd like. Now, again, since I have a lot of resources we follow, some of the resources we talk about are screaming about how the sky's falling and the world's over and it's going to be terrible. And some are acting like nothing's wrong, everything's perfect and humming along wonderfully. And so our goal, my goal, is to try to find the middle ground in there to identify what's really happening. Is it really that sky's falling, or is it that we just see potential dangers down the road, but for say the next 2 or 3 quarters, that might not be the case? That's how I tend to operate, trying to look out quarters and then years to get a feel for it. So at this point, I would say I'm feeling okay. I recognize the dangers and problems we're seeing, and as you'll see tonight, I'm going to show you a reason why we're making some adjustments accordingly. But overall, I'm not panicked in any sense of the word, but I am watching just to make sure that we're not being caught off guard. You're not being caught off guard in any of this. And while none of us are perfect and none of us can claim to have the right answer all the time, we're trying hard to make sure we stay on top of this, and using raw data like this is one way we're able to pull that together. Now, what I want to do is I want to spend a few minutes just kind of examining the stock market. In this case, I'm just looking at the S&P 500, the Dow, which is the 30 largest companies in America. It's a fair model to look at, but I think the S&P 500, which represents the 500 largest companies divided out by various industries, is a little broader index to look at. And I've gone back to 2000. 2000 seems like it's sort of a mile marker in the process. I can tell you, for me, I got into this industry in 1986, and so from 1986 to 1999, other than just a couple of short-term events, I thought I was brilliant. I was amazed how our clients were doing so well. And then 2000 came along, and the world changed a bit. It changed a lot, and so I think that as we go forward here, I'm trying to help clients understand how this situation works, how the economy and the markets work, and maybe to help give them some confidence that we're seeing things and to help them maybe manage expectations a little better as well. So that line up there at the top where it says, warning, investing in equities appears easy, but it's not. It's an activity requiring calculated risk, intestinal fortitude, consistency, persistency, and patience. And I find that during a lot of downturns in the market, which kind of speaks to where we are today, especially if the policies and politics aren't quite where some people want it to be, it tends to be more problematic and tends to be harder for them to hold on and feel comfortable as things happen. Let me just double check here. Okay, very good. So what we're looking at here in these downturns, again, going from 2000 till now, and looking at this particular period here, which is due to Y2K and 9/11, probably more specifically 9/11, but Y2K did have a big impact in why the market fell as voraciously as it did. The Great Recession, which is 2008 until now, and then we see this period of time where it went up very nicely, and then we see where we are today. This period right in here is the pandemic, and that's really part of that big time that just happened not too long ago, although for some reason it seems like it was a long time ago, and yet at the same time it doesn't seem that far back. So let's break it out into a couple of periods. The first period I want to look at is the S&P 500 from January 1st of 2000 to December 31st of 2013. And that's this period of time right here. So the S&P during the Y2K 9/11 event took a big hit, came back up, got up to this high point. Then we move into the Great Recession, takes a huge hit rapidly, works its way back up. And by early 2013, we're back on pace again. We have actually got the markets back up, and we break through and take off again. Now, on a graph like this, that looks pretty easy. It's not too hard to see, but I will tell you that this period of time, 2000, 2001, 2002, was terrifying. I don't mean terrifying in the sense that I was panicked every day, but for clients, they were concerned continuously. Concerned. They hadn't seen anything like this. They had just seen 2 decades of growth from the 80s into the 90s, and they were seeing this and they didn't really understand why, and it was lots and lots of conversations. The conversations had to do, quite honestly, with the fact that if somebody retired here, they lost a significant amount of their portfolio. Many people had to go back to work. I'm not talking about I'm talking about across the country. There were people who retired who had to go back to work because their 401ks were devastated. And so it created huge amounts of discomfort and concern, and in some cases even panic for people. And then when we got into 2003 and things started to turn back up, you would think, well, okay, well, that's good, right? Except for the problem is that people are still panicked from this. They're still remembering this back here, even though they're seeing it come back up, they're still concerned. And so it came back up, kind of hit this high, went down a little bit, took off again. And during this time, most people were still panicked about whether they should actually invest or not. It didn't matter what we were telling them. It mattered that the news was scary. There were lots of things happening. The housing market was blowing up. There was all kinds of pieces to this that were causing people to say, oh, I just remember that, I don't know. And it was a very difficult time for people. Then we get to the things starting to feel good again. We're here in 2006, 2007. And then the world falls apart again because of the housing bubble, and we had lots of problems in the economy, and the markets reacted to it, and we had mortgage-backed bonds, which were thought to be unsure, and people were worried, and so the market tanks rapidly. And I can tell you what we did during those times and how I was very pleased with performance and how things worked, but the bottom line was it doesn't change the fact this was a very difficult time in conversations with clients, not only managing money, but even more importantly, managing expectations. The economy does take off again here in 2009, but people aren't feeling comfortable yet. We have a little bit of pullback, it takes off again, another pullback, takes off again, and then finally breaks through. Now, the reason I tell you all this is because on a graph like this, we just kind of gloss over it and move on and go, oh yeah, that wasn't that big a deal. But the truth is, it's a huge deal when you're going through it. The other part that's a problem is that what people need for return on investment, ROI, is impacted by what we're seeing here. For instance, if you were just in the S&P 500 and you weren't receiving any dividends, you just have the stocks and making some, you didn't have any interest or anything, you can imagine it took, from here to here, took 13 years to break even. If you were getting dividends, that fixed that and that helped you a bit if you weren't spending them along the way. So that kind of had a big impact on that discussion, but 13 years to break even. And to put that in perspective, let me show you this. So if I take a look at the markets each year, 2001, 2, 3, all the way down to 2013, and we can see the annual returns for each of those years, minus 10%, minus 13, minus 23, then we have a plus 26, that was good, a plus 9, a plus 3, a plus 13, a plus 3.5, minus 38, almost 40% down, plus 23, plus 12, flat year, 13, and then 29.6. In that time, you'll notice that out of all of those years, 14 years, only 4 of them are negative. The rest are positive. And some are significantly positive, and some are minorly positive. But out of the 14 years, 10 were positive and 4 were negative. That's important to understand because it gives credence to the fact that the markets are a great opportunity. But here's another piece to it, though, is that with those average annual returns, pluses and minuses, it worked out to an average rate of return over that period of 3.55%. Now, what that means is that most people invest in the stock markets and they're thinking, oh my goodness, I'm going to do 6, 9, 12. They have some numbers in their head on what they think is going to happen, 5 to 10%. But this shows you for that period of time right there, 3.55 was the average. But the bigger problem is for people, and the reason I'm trying to highlight this is not to say don't invest in the stock market, but rather to help identify how we can work with things at different times. Because here's what the problem is. When the markets go down, and if it does it 1 year, then 2 years, there's this tendency for clients to say, let's pull back, let's pull back. And then when it comes time to put the money back in, they tend to be resistant to put the money back in because, well, they just lost and they don't want to go back to the very thing that lost. And so it gets harder to get them back in. And so having that ability to get in and have that persistency and consistency, have that patience, that intestinal fortitude, I'd love to tell you we can transfer that to people and they'll get it, but sometimes they don't. And so it causes a challenge in trying to keep people invested. And so we work to try to balance out portfolios to offset that because, and here's what I think the real reason is. So while the rate of return, the average was 3.55, the actual rate of return was only 1.65 using just the price point on the S&P 500, not with dividends. That would improve it 2 to 3% if we add the dividends back in, but using just price points. So here's what that means. It wasn't because of taxes or investment fees. What it was because if you invest $1 and the market goes down 10%, that following year you have 90 cents. If the next year goes down 13 cents, the following year you have 78 cents in your account. If it goes down 23%, you now have 60 cents in your account. So that next year when it goes up 26%, you only have 76 cents in your account because it's not 26% off the dollar, it's 26% on that 70 or 60 cents right here. Then it goes up, 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 and then we get right to $1. In 2007, we get right back to that dollar again. And then the market falls, and so we're back down again. And you'll notice on this chart, it's not until 2013 that we break above the dollar. And that is this $1.26 here works out to a 1.65% there. And that's where it's hard for people to make that work to stay invested. So that's why we try to invest in things outside the S&P 500 or other equity positions to try to help give us growth and opportunities. That's why I show you those 8 circles to try to help clients have more stability, more opportunity. But if 50% of the portfolio is going to be in equities, they're going to have a greater intestinal fortitude for that. They're going to have to understand the calculated risks of what we're doing. And if that's not good for them, if their risk tolerance isn't good with that, then we have to understand that and make even better decisions along the way. Now I'm going to show you what I mean by that as we go forward to, say, the next period of time. In the next period of time, it did come back finally. We see that. But what happened is when it came back, it was slow. This is 2017. So yes, the market did come back. So here's 14, here's 15, here's 16. And so by the time we get to the end of 16, it has bumped up again, and that's really good. But what we see is really not until 17 that everything starts to really take off again. And then we have a downturn in 2018 that's problematic, but honestly, it comes back pretty quickly. It's within a couple of quarters, it's right back up again. And then we hit the pandemic in 2020, but as the administration had said, it was a V-shaped recovery, and so it ends up the year at a really good position. Now, it was a wild year, a lot of changes here, but it still, in the end, worked out well. And if we take this particular period of time and do the same calculations with it, we find 2014 was 11, this was down less than 1%, up 9.5, up 19, down 6, up 28, up 16. Gives us an average annual return of 11.22% per year. Then we take the $1 experiment, come down here, $1, it comes up 203, we're up 10.66% for a total value on our dollar, $2.03. That particular period of time, those 7 years were really, really good. And again, that's what we count on for the markets, that it's going to have some good years and some bad years, or we're hoping over the long period of time we'll have more good years and bad years. And by doing that, we know as an investment opportunity, it works pretty well. I'm going to get back to diversification in a second, but I want to deal with one more set of time frame here, and that's what brings us to today. So here we are, this is 21, and then here's 22. So 21 went up, was doing pretty good, and then 22 has been pretty nasty, and then currently 23 is actually working out good so far, but if we're going to have recession, that could change that. But rather than jump ahead, let's take a look at this here. So this is 2021 and 2022, and how did that work out? Well, what we see is that for those 2 years, average annual return in the markets was about 3.72%, but the actual rate of return was 1.11%, and our $1 grew to $1.02 in the venerable S&P 500. Again, not counting any dividends that some of those stocks would pay, just the S&P 500 by itself as an index. So now, if we take all of that, those 3 different periods, and we look at them, we say, well, how did that work out overall? Again, as I said before, investing in equities may appear easy because everybody's like, well, the S&P 500 is going to do, and you name the return you're expecting. But we can see that sometimes it doesn't quite work out like we'd like. So if we take those entire 23 years, what we find is average return was 5.9%. We'll call it 6 to keep it simple. But actual rate of return was 4.26. And as we saw a moment ago, most of that happened from 2014 to 2020. Now, that's not terrible. I mean, 4.26% is not horrible. It's better than what CDs did during some of that same time frame. But the bigger issue is that if a person got invested into the markets and then later on, because it dropped, they pulled out, they didn't recover because they couldn't have recovered if they missed some of those years. If we stayed long-term, a buy and hold strategy, it wasn't terrible, but it's not the rate of return that most people are expecting when we take a look at investing. Again, it's not that this is a bad number, it's just that it's not the number that most people expect. And so one of the reasons I wanted to spend this month, last couple of months, I talked about using more tangible or traditional kind of investments that were linked to reality rather than just expectations or thoughts. And by doing that, we could start to find some ways to maybe fix some of this that we're seeing. Because from my viewpoint, even though I love the markets, there's a lot of value in what the markets can do. And I'm just using the S&P 500. But if I were to take it and move it across a spectrum of different investments, there's a lot of great opportunities out there if a person has intestinal fortitude, they have persistency and consistency and patience in what they're doing, we can take and make that work well. But I also recognize a lot of people are challenged with that. It's like, oh my goodness, I gotta make this work, especially if this is my retirement income. And so that's why we make some other adjustments along the way. So now, what are we seeing in the markets today? Now, this is just this most recent period of time here, going back 6 months. And so what we're seeing that we've kind of hit this sort of top where we haven't broken through yet. We do see that the 50-day moving average is moving positive, as well as the 200-day moving average has just turned positive. And we've also seen that the lows are getting higher. So what that means is that the highs may not be getting higher, the lows are getting higher. So as that comes together, what we might recognize is that might force it either to break up and go higher, or it could break down and go lower. And considering that many are expecting a recession, even if it's going to be a shallow one that lasts for a few quarters, it might be hard to get the market to rise too much higher than this. It might not be, but it might. And as I showed you the numbers last month that we were looking at from some of our resources, it looks like we're going to have some economic challenges along the way. Some could be worse than we're expecting, and others might not be as bad, but it does look overall like there's going to be some challenges. And so we're tending to be a little more cautious right now. Now, the reason that I showed you, I guess I want to go backwards. The reason I showed you this chart is because I find myself feeling this last bit of time right here may feel more like this to me. I'm not saying it is. I don't have, I don't have knowledge from on high what's going to happen any more than anybody else does. But there's just certain things that feel like they're going on out there. The rising inflation, which I think is kind of silly that we decide to print money and then raise interest rates to slow down the economy. Why not just print less money, which is going to help avoid inflation? Why not, better yet, put money back on the gold standard so it minimizes inflation continuously? As I shared with you a couple of months back, I think they do that because, well, that's how you can get things like the stock market to perform. If you've got lots of cash flowing into the system, that cash has to go somewhere. Well, if interest rates are low, it's not going to go to banks or CDs. If interest rates are rising, it's not going to go to bonds. The stock market is one of those places. Real estate is another one of those places. If inflation's happening, even though it hasn't really shown itself greatly so far, but certainly commodities and metals may benefit from that. My point to all this is that there's some things out there, if I look at policies, that make me think maybe we're in a little more of a volatile time frame than what I would like for us to be. And so as I look at that, being that I went through this just like you did, we're looking at, well, what could we do this time around, if that's the case, to do better than, say, 4% or 5%? And I can't guarantee we can do better than that, but what would I do if I was trying to do some things different, especially if I am looking somewhat at that model a bit? So that brings me to this point here, and I shared this last time, making decisions in difficult times. And what I would say again is just like Mark Twain said, history doesn't repeat itself, but it does rhyme most of the time. And so when I'm looking at black swan events, and there could be some things coming, and not that I have any knowledge or insight, but I do recognize that we didn't really see the Great Depression until it was on us. We didn't see the 1970s stagflation until it was on us. We didn't see the Great Recession until it was on us. We didn't see the pandemic until it was on us. And so in today's world, the culture, politics, philosophical disparities with people and governments and politics in general, corporatism, and how governmental finances work, it makes me think I want to be more careful than I want to be aggressive. I want to look at things that might give me more confidence going forward rather than taking huge amounts of risk. And so we're trying to identify investment choices that maybe can bring that about and bring us decent rates of return at the same time. Now, like you, I'm a voracious reader, consumer of information. I'm always trying to figure out what to look at, and I'm looking in all kinds of places. And I shared this with you last time, but I'm gonna share it one more time because I think it bears repeating. That when you kind of look at sort of the universe of knowledge, which is kind of funny when you look at, if you've been following any of the GPT AI stuff, last night Elon Musk did an hour-long interview on a program, Tucker, and it was interesting watching Elon Musk's take on things. I guess he's having the second hour tonight. If the universe of knowledge is what we think it is, apparently AI is adding to that from some other things that I've been seeing lately. But whatever that is, you and I, we have this sort of universe of knowledge, things we believe to be true, things that we might even say we know to be true. And that's that first part of that universe of knowledge, things we are certain that we know to be true. And that would mean we recognize some of these things like, what the S&P 500 is, or where your house is, or what politics you believe in. Those are things that we might say, I know these things to be true. Simultaneously, there are things that we know about, but we'd acknowledge that we don't really know about them. For instance, I know that there's such a thing as brain surgery, but I really don't know how to do it. nor do I even know what I would do if I had to do that. Matter of fact, I would say that, do-it-yourself brain surgery might be very problematic. I take out might, say it would be very problematic. But I would say, for instance, do-it-yourself electric repair at your house probably is something you shouldn't do. Have the electrician come and do it because it's too complex. I'm a smart guy, but I know when I'm in over my head. And I think understanding what I don't know is just as important as understanding what I do know, and learning from that, and then recognizing that what I know to be true and what I recognize that I don't know really leads me to say, well, how do I expand that universe of knowledge? Because everything else is in my blind spot. And if I want to know more, there's really basically three ways I can know more. One, I can identify from the places I go, new experiences, information that can help me make better decisions. Number two, things I read or consume or see. Those things that personal study can help me to gain in knowledge. And then finally, the people I meet, the people I choose to connect with, can transfer knowledge to me. So between experiences, personal study, and transferred knowledge is how I can begin to fix my blind spot a bit. Now, what I tell you, and you probably know this to be true as well, is that of the things I know to be true as I have gained experiences in personal study and transferred knowledge, along the way, I found out some stuff I knew to be true wasn't true. I thought it was true. I was convinced it was true, but with more information, I was like, well, maybe that's not true. So I've learned a lot in that and found, quite honestly, there's things I thought were true that I learned weren't true, and I've made adjustments accordingly. But at the same time, as I expand my universe of knowledge, it also expands other pieces of it. So I have less blind spots. I catch things I didn't catch before. And that's one of the reasons why I was showing you that breakdown of the S&P 500 for these last 23 years, to kind of give you an understanding that what we have to do is think carefully how we're going to generate or create, grow, protect, and preserve wealth going forward if we're going to go through another more volatile period of time in the economy or the markets. And so that's why I wanted to spend some more time with you this evening, just kind of identifying truth and then identifying process, and then begin to think about how do we make this work better. So with that in mind, I'll come back to here now. As I shared with you last time, I think that we try to add in information, we try to gain understanding, and we try to implement wisdom in those items to make good decisions going forward. I know you're doing that. I talk to all of you on a regular basis, and I know you're trying to do the same. And so together, each of us are working to make the right decisions to protect and preserve wealth, but also to create and grow it at the same time. So when we look at the 8 circles I talked about before, and maybe most of you, or at least some of you on here tonight, are like, oh my goodness, I have to see this thing again. Well, it's critical because we don't put all of our eggs in one basket. We want to have some eggs in cash reserve, some in bonds, some in equities, some in real estate, some in tangible assets, and some in currency, and some in business interest, and then some that maybe is in insurance or annuities that protects or stabilizes our investments. And together, all of those pieces can diversify so we don't have all of our eggs in one basket, and we are expanding our opportunities and maybe taking advantage of times when things are working better and minimizing damage when things aren't working as well as we'd like. So I referenced this last time. I wanted to spend a little more time drilling down on tonight and how we invest in this challenging environment. And so for those of you I've talked to probably in the last 30 days, we've shared some of the newer things that we're working with and how we're taking advantage of that. Some of those things require you to make decisions. You say, well, I'd like to do more. I'd like to do more of that. Some of them don't require that. And so that's why we're taking time to go through everybody in this next 60 or 90 days to make sure that we have communicated with you what we're doing and how we can make this work better if we're in for more volatile times. And even if we're not, how we can make it work better as far as the growth of wealth, whether it's through income or growth or a combination of the two. So how to invest your portfolio in this challenging environment? Well, let me share with you some of the things that we're looking at how we're doing, looking at what we're doing and how that impacts you. So the first thing I'd point to is that first item, cash reserve accounts with daily liquidity provisions intended to yield lower single-digit returns. And just to kind of put things in perspective, there is no perfect investment. I know I'm telling you something that you already know, But think about it. You could have a car that could go from 0 to 60 in 3 seconds, but that car probably can't pull much weight behind it. Or you could have a pickup truck that doesn't do that, but can pull a lot of weight. Or you could have a semi that is even slower yet, it pulls a lot more weight. So investing's not all that different. You can choose investments that are more liquid, but they're going to pay lower returns. You can choose investments that are less liquid and they may pay higher returns. You can choose investments that are more conservative, which will produce lower returns. Or you could choose investments that have more risk that might have higher reward. And so trying to balance all the pieces out is a critical component to making good decisions. And so this first item here, using savings accounts, money markets in our case, passbook savings or savings accounts, or maybe money markets at your local bank, where they're liquid daily, you can access them, they pay lower rates of return. Returns could be anywhere from 3 to 5% in today's environment, although I've seen some savings accounts still paying 1%. So I don't know how that works where you are, but for us, we're looking at accounts that are going to be below 5% for sure, but they're liquid, they're available, they're great for cash reserve needs, emergencies, or opportunities. And I will say that the reason they're listed on here right now is because just a year ago, it was hard to even get them to pay any reasonable interest, but at least now we can. So I'm liking that. I'm liking that we're getting a little higher rate of return, even though it's still on the low side. It's for that liquidity, for that money we might want to access quickly. It's nice. It helps that extra 3 to 5% really helps to grow. It helps to keep our clients' money working for them. The next is long-term investments with quarterly liquidity provisions. They're still long-term investments, but instead of having daily liquidity, they have quarterly liquidity, meaning that once a quarter, our clients can pull money out of them. And these are intended to yield mid-single-digit returns. They're not going to be as low as a money market. They're not going to be high single digits, but they're going to be better than what a money market account is. And you know, it depends on which ones you use as to what that would be, but we'd be looking for them they'd be intended to produce a return somewhere between 5 to 7%. Depends on the investments. It also depends on sometimes the underlying investments that might, if the economy goes south, have a little bit of a drop. Bottom line with that is that it produces a higher return than our liquid money, but it still has liquidity provisions in it, but it's still considered to be a longer term investment. And that's why it pays a little higher rate. At least that's what its intention is. Next one, long-term notes or certificates, like a CD, for instance, with limited liquidity provisions intended to yield high single-digit to low double-digit returns. And so we could use the markets, the S&P 500 or the Dow or the Amex, we could use NASDAQ, we could use any of those types of programs for this. But then we have no protections built into it. By using these longer term notes and certificates, which have barriers or buffers built into them, we can actually create, while limited liquidity provisions, we can get higher yields on that money for our clients and still have protections in place that make it so that if the markets are volatile, we might not experience all that and have some greater growth potential than, say, what I was just showing you on the S&P for the last 23 years. Again, no guarantees. There's no, you know, in anything that we work with, we are very clear to point out what we think is going to happen, what the intention is, but we recognize that each thing has its pluses and minuses to it. And so on this one, I would clearly say that this is something that we should talk about. I'm not going to go through details because I don't know everybody's situation on here who's talking right now, and so who's watching right now. And so I want to make sure that if you were to consider doing something along this line, number 3, that we would have a good understanding of what the pros and the cons to it were to make sure that fit with your situation when it comes to creating, growing, protecting, and preserving wealth. Next one, investment accounts with riders that protect principal or income or both. So they are investments that we can choose with various companies. That goes back to that insurance and annuity circle that I showed you before. They have riders built into them that will protect or buffer against market experience. And that protection can be that it locks in income, and the insurance company will, through faith and credit in their provisions and processes, that you would have that income guaranteed for a period, or in some cases even for life. And so it kind of gives you some ability to invest with a little more aggressiveness a little higher risk. You might give up a little reward to be able to have that, but you would know you'd have a good mixture for income or growth or both, depending on how this is set up for you. Again, if I'm going through the volatility of what I showed you from 2000 to 2013, having some of these protections in place is just amazing. It's awesome. But it doesn't mean that there aren't going to be costs or challenges to it. And so that's why, again, you'd want to talk about that to make sure that fit what your situation was. The next one, growth investments that are tied to more tangible assets. Again, I'd mentioned before how we have seen equities do well during periods of time, 2014 to 2020, but another great performer has been real estate. It gives up liquidity. I will tell you that if you're going to do some of those types of investments, it will give up liquidity, but it can give you some better rates of return. And at least that's the plan for it. And so we work hard to go through that with everybody to make sure that what we're looking at as far as the investment's risk and reward, its income, its growth potential, its flexibility or liquidity aspects, to make sure that works well. But part of the goal of it would be that it minimizes the volatility we find from the equities market. But not to give up on the equities market, another thing that we do at times like this is use dollar cost averaging, where we might take a portfolio and put X number of thousands of dollars into the cash account, and then systematically every month move over X number of dollars, could be hundreds or thousands, into an equity growth position. So that way, when the share price is high because of volatility, we buy fewer shares. When the share price is low, we buy a lot of shares so that when it comes back up, it helps to average out a better return. Again, that works well if the market's going up, but if that volatility goes down, it doesn't work quite as exciting as we'd like for it to, but it certainly is a potential path to getting growth without having to take some of the risk if we just take a big chunk of money and throw in the market and then watch it fall 5, 10, 15% because of volatility. So with these various strategies, especially in a more volatile time, these are ways that looking back to 2000 to 2013, I think these are areas where we could find a better opportunity, and I would underline the word opportunity, to help clients maximize growth while minimizing some risk. And what that means will be based upon the types of investment choices you make, and the process, the underlying investments for those, which brings me to this next point. Should be obvious, but I have to tell you, I hear it every once in a while. Remember, you can't invest more conservatively than the S&P 500 and expect better performance than the S&P 500. Now, granted, if the S&P 500 is going down, I get that, and so you'd hope it would be better if we're more conservative. Makes perfect sense. But one of the reasons I showed you 2000 to 2013, or including 2013, and then I showed you from 2021 and 2022, is because you can see that even though the rate of return is better in the average return, but the actual is actually less, because when you have those volatile times, you have to climb out of that hole and make that money work as well. So understanding what is a good comparison, a good benchmark for your portfolio, is another one of the things that we're trying to do with each client, to say this is more likely what you should expect with your risk and reward profile, especially if we're going to go through some volatile times. If we were to have some flat periods in the economy, even though the market's going up and down, but it ultimately just kind of doesn't break through the ceiling, I want to make sure that clients have a good understanding and we have a good plan in place, not just to do that, that's not what I'm trying to do, but to actually see how we can make more money for them during those times and exceed expectations and maximize return on investment based upon a client's risk tolerance. No perfect answer, just trying to get to the best place for each client to meet their long-term planning goals. So the next to last one is this. Remember, just ask questions. This is your money, and there are no dumb questions. So clients sometimes say to me, well, I didn't want to be rude or ask a question. My goodness, ask the questions. Sometimes you might find that your question causes me to understand something different, that we can help you make better choices, which is always what this is about. And as always, join our next Investor Advisor Review, because we're trying to constantly give you information to help you make better and better decisions. We're a team. You're the boss, we're the employees. We're trying to help you figure out what works best. And the more, and this is why I talk a lot about fiduciary, The more that we understand what your needs are and what your desires are, the easier it is for us to make better and better investment choices for you or with you. So as I said before, I and our team believe in fiduciary wealth advisory. We think that requires a dynamic financial planning strategy, and we're committed to providing that for our clients. So it's not just about how we invest money. It's not just about how we manage risk. It's about having a financial plan that's identifying the return on life our clients are looking for, that you're looking for. Having a plan that identifies what your bucket list looks like and doing everything we can to help create, grow, protect, and preserve wealth to get you through that. And then as we deal with the transitions that life throws at us, trying to stay ahead of those as much as possible to identify liquidity needs or cash reserve needs, to identify strategies to keep more money on your side of the balance sheet rather than giving it to taxes, fees, or expenses. So by having that process in place, not just a plan, but a plan that looks at the investment strategies and risk management strategies, that to me is how we build a fiduciary process that helps you accomplish your goals. And it's a team effort. We can't build a plan without you, and we provide you great tools to make that work. And so that's how we tie this together, not just to say, well, so the investments have to do this, but rather how do we maximize investment return while minimizing risk to what your tolerance is, reducing taxes, fees, and expenses every place we can, minimizing risk to loss of income or assets to keep it so you're not trying to catch up all the time, and doing that in a way that achieves the goals and desires you have for life. That's how I think that we create a great wealth advisory model. So what that means is that each of our clients is going through one of these three phases. Some are in the accumulation phase, pre-retirement. Some of them have already planted that flag and they've retired or redirected, and they're in the decumulation phase, post-retirement. Some of them are early on, so we're dealing with sequence of return risk, trying to make sure that their portfolio doesn't get hurt in a bad period of time, making it so it makes it more difficult for them to stay retired. Some of them are further down the road. Some of them are dealing in end-of-life issues right now. Some of our clients are getting ready to transfer assets onto the next generation. And so we're helping each group try to maximize that process while working to continuously achieve their desired return on life. Again, I don't know how you do that without knowing your clients well, and that's what we try to do. And that's why we put together this suite of premier, or what I would hopefully call concierge wealth advisory services, with planning, trying to pick out great investment strategies, trying to pick out great risk management strategies to help through all three phases of life. So this website, our website that you've seen, you have your financial dashboard, which hopefully will make it so you start to have even more confidence that you're okay, that you're on track, that even if we have a bad year or a difficult economy, whatever the case is, you can look at your dashboard and we can do an extrapolation into the future, and you can say, oh, look, we're on track, we're going to be okay. We've got either a really healthy blue curve, if you know what I'm talking about from our previous conversations, or a runaway green curve, and things look good. And if you have a red curve, which means you run out of money before you run out of life, hopefully we're in the process helping you identify how to extend that curve to the best ability possible. So this is identifying what you own and what you owe and your income and your outgo. This is helping you define what we manage for you, so you can see insight and direction to what we're doing, and you can see all of the things that we manage for you directly held right there. So this one shows both our stuff as well as stuff you have, investments you have outside of us. This one shows just ours and attaches performance data to it to help you understand what we're doing. Risk reward evaluation with Riskalyze is how we try to help our clients understand how much risk they're taking versus the reward they're expecting, to make sure they're not taking too much risk and that everything is working well to meet their longer term needs. And then this is where I talked about with the bucket list. You know, it's not about just the facts and figures, it's also about your feelings. And I don't mean to sound all goofy about that, but there's things that you want to accomplish, desires that you have for you, your family. We want to make sure that we're on track to get that done. And then we also use this to help identify transitions coming up, to make sure that with your wealth, as we're advising and helping with that process, that we're understanding what we need to be thinking about in the next 12 to 24 months as well as the long-term needs at the same time. So now I'm going to go ahead and open up for questions. I see a couple of question marks here. Let's see what we've got. Okay, Diane's having a hard time tonight. She has sound, then she doesn't have sound. Hopefully she's got sound back again. I don't see any questions this moment, though. I don't see any raised hands. So it's about 6:20 right now, so I've got about 10 minutes left. I am more than happy to entertain questions. Oh, here, there's a hand now. Let's see what that hand says. Okay, nope, it's a hand up. So let me see where that's at here. Okay, that's Carol. All right, Carol, I'm gonna unmute you. You might have to unmute yourself as well, but then you can ask.
You unmuted me and I lost you.
Uh-oh, but
there you are. Okay. You're back. Okay. Actually, I have two questions. I'm reading about China settling the first liquid natural gas trade in a currency that I don't know how to pronounce, UAN. Okay. And I'm wondering what those implications are, because apparently that's a huge deal that it's not in US dollars, and what that spells for our future.
Yeah, that's a great question. I'm going to mute you for a second. That's a great question, and it's a very complex question, and I'm not going to claim that I have all the understanding here, but in all of the research that I've been doing with our investment partners, both inside and outside of all of our relationships, we've known for a while that China wants to become the reserve currency of the world. The U.S. currently holds that spot. They actually took that position of the reserve currency of the world. They took it from the United Kingdom back after World War II, and they actually got it, I believe, from Dutch. I think they got it from the Dutch. So that has swapped over time, and China has a desire to become the new reserve currency of the world, meaning we'd all trade in yuan, if you will. Now, what does that mean? Simply put, if you travel, you recognize that most of the places you go, you can trade dollars for their currency very easily, and they recognize the US dollar, and it all works out very well. The second part of that is when it comes to buying oil, it's called the petrodollar. And again, the oil has typically, for the last number of decades, many decades, been purchased in the US dollar. So what China's doing here has formed a sort of an agreement, or at least they're testing an agreement, to be more accurate, with BRICS, which would be Brazil, Russia, India, and China, and South Africa, to say, hey, we're going to use the yuan, and we're going to buy oil in the yuan, and that's how we're going to do this. And so China's made it very clear their goal is to replace the US dollar, and this is a step towards them attempting to do that. At this point in time, other than those nations, most people don't trust the yuan. They don't feel comfortable that China could be trusted as a currency. And when I say that sentence, let me kind of express it slightly different. There may be currencies that are stronger than ours. Let's say, for instance, I'm not saying it is, but let's say the Swiss franc was a stronger currency than the US dollar. They could not become the reserve currency of the world. And the reason they couldn't is because they don't have enough money in circulation. If they were to have enough Swiss francs in circulation to fulfill the needs of the world, it would devalue the Swiss franc so far that it wouldn't even be functional anymore. So one thing an economy has to have is large enough currency circulation to make it so they could even function well. So China is large enough, and so they could, with the yuan, do that. But then another piece they have to have is they have to be trusted, meaning that you have confidence that if you are using the yuan, that there's not going to be some funny business being done behind the scenes to devalue the currency or to strengthen the currency that aren't real. And that's the big problem China has. They're big enough that they could do it, but they're not strong enough or trusted enough. Plus, there's a lot of, when you look at the economic data for China, yeah, they've got some GDP growth coming on, and they've got some growth in certain areas, but they also have huge amounts of problems. Their real estate is so overinflated that there's concerns about what would happen if we actually had a worldwide recession, like a depression, I mean. There'd be a lot of challenges there. You may have heard of the Chinese ghost cities, that are built for literally millions and millions, tens of millions of people, but nobody's there. So there's lots of things going on with what China does with their money, with their business, their nation, that make it so that they really aren't ready to do that spot yet. Having said that, though, that's what this is. This is their attempt to move in that direction. And while it certainly is a little, I suppose, disconcerting to some, in some respects, it's a little bit like the euro. The euro was an attempt to do a different version, and it failed because those nations weren't ready to do it. And quite honestly, most people don't think that BRICS is ready to do it yet either. All right, that's a very short, simple answer to a more complex conversation, but let me unmute you, Carol. Did that help, or do you have more questions on that?
Nope, that's good. The second one I just put in chat.
Okay, let me just flip down there. I'll have to make this bigger so I can see it. How do I do that? Give me a second. Nope, good. All right. Okay, there we go. What are the implications of the IMF unveiling the unicorn? Wow, another really complex question. All right, so here's what I say again. You know, I'm not an expert on this one either, but I, like you, do a fair amount of reading, and so I'm curious about some of this. So right now, there is a big move towards a central bank digital currency, CBDC. We have digital currency right now. Matter of fact, I was just reviewing a report from a sort of a test that was being done called Project Icebreaker, and it was a desire to say, how could we create a digital currency that could be traded across borders? And it had limited success. It had some pieces to it, but it had lots of problems with it as well. It's one thing to have digital currency, say, in the U.S. or in I don't know, Canada or even Mexico. It's another thing to try to go cross borders with currency exchanges and so on. So here's what I would say. There is definitely a goal to do that, and it will certainly be something that will happen ultimately. And when it happens, I think half the people are going to think it's wonderful and half the people are going to be terrified of it. But it will happen. There's too much motivation behind it. It might be that it could be within years, but probably more realistically, it'll be within decades. But again, you know, things can change. You know, the pandemic changed a lot of things. So consequently, with what's going on with AI, that could change things, and we could see some things happen faster than we think, or maybe not. But at this point in time, having a digital currency with the IMF, the World Economic Forum has so many people who don't trust it. The IMF trying to yield something like this is really just a step out. When they unveil things like this, it will be met with various excitement and with concern. I think that the short answer to the question is, I don't think this is the one. I don't think this is the thing we need to worry about yet. But I do think that it is something we should definitely keep our eye on, and hopefully we'll get a better understanding of what to do with this as we go forward. Now, having said that, last piece is that I do think that there's going to be a huge amount of wealth created out of the first digital or cryptocurrency that is nationalized or internationalized, and I think that is going to be a big event when it does happen. But I think that much like we see Bitcoin or Ethereum or the hundreds of other cryptos that come out, I think that probably it's still more of a nothing burger yet, but time will tell. So again, if you get any questions or you see something that you think would be important, please, please, please forward it to me. I'd love to see it, because if it's something I haven't seen before, I'm gonna eat it up. And if it's something I have seen before, I'll talk to you about what I think, and together we might come up with a good solution for it. So hopefully that will help with that. All right. So our next investor advisory review will be May 23rd. That's not the typical when we do it. It's out of range because I'm out of town the previous week, so I can't do it then. But just as I told you last time, if something dramatic happens, which I don't think is going to happen, but if it does, then we will do an update before May 23rd. I would be more than happy to let you know. But at this point in time, and I said this more last month because I think we were kind of worried with the banking issues, which I didn't really address that tonight. We've done a lot of research. One of the things that I did find, and I got a report on that that I went through in detail. So when the Federal Reserve said, hey, you know what, we're going to backstop banks, and at that early point of that discussion, just after our meeting, the Federal Reserve was putting out roughly $70 billion a day to backstop banks, not because the banks had failed, but because they were making sure that there wouldn't be a problem. They were trying to shore up. Today, that dropped down to about $5 billion a day. So that's still a lot of money, no doubt, but it does imply that while there may be some other issues that pop out with the potential banking crisis, it looks at this point like that may not be a real issue, or at least not something that's substantive we'll have to deal with. But again, every day is a new day, and every day things change. So if something does come up between now and then, I think it's important, we will be offering an investor update between now and that next one on May 23rd. So hopefully what I've done today is spend some time with the market and the economic review to let you know where I think things are and what I'm seeing, and hopefully you have some better feelings about it. Wanted to spend some energy showing you how we're investing and making adjustments during challenging economic times. And if anything I said tonight causes you to say, you know what, I want to get with you and visit about that, please reach out. I'll be happy to schedule. We're going to be reaching out to each of you, but don't wait till we call you. Feel free to call and say, hey, I want to go over some of these items you were talking about on how you're investing in challenging times. Talked about strategies for creating, growing, protecting, preserving your wealth. Reminded you again of the resources you have, and I really hope you're using them. That's what they're there for. That's why I put so much energy and money, to be honest with you, to make sure those are available to you. So please use those. Hopefully my final thoughts gave you some confidence, didn't make you feel more queasy or anything. And your questions, I see I don't see more questions right now, but you know, if you have more questions, I'm here for you. And even after this is over, if you want to email me, be happy to get back with you on that. So as always, you are invited to the next one. Caleb will be sending out information. If you have friends who you think might benefit from this discussion, please feel free to let us know. Be happy to invite them as well. Also, we're trying to get each of these on the website, and you can go there and re-watch them, or if you've got a friend that you want to see something you think might help them, again, you can certainly share the website with them as well. Outside of that, went too far. Outside of that, that kind of covers everything I wanted to hit on tonight. It is 6:34, and I am ready to go home and have some dinner. Hopefully you've had some dinner already, or having it, or going to have it, and you're going to have a wonderful night and a great week. And as always, it is my honor and pleasure to serve you and your family, and I hope if there's anything we can do to help, please let us know. We are here for you. So with that, I'm going to head out. God bless, and I will look forward to talking to you all soon. So have a great evening and a great week. Bye-bye.